Practice creates the master. Miguel Ruiz. You've heard it before, just moving averages. But when you pull up your chart and add a few lines, it's like stepping into a maze. One's lagging, one's moving too fast, and you're left wondering, which one do I actually trust to guide my trade? You want clarity. You want consistency. But instead, you find yourself second-guessing every crossover, chasing late entries, and exiting too early because you're not sure what the chart is really telling you. And let's be honest, trading without a clear strategy feels like gambling in a storm. But breathe easy, because that confusion ends today. In this video, I'm breaking down my signature 20 exponential moving average strategy. The exact framework I use to time entries with precision, confirm momentum, and simplify every trading decision I make. So if you're ready to stop guessing and start mastering your moves, drop a comment below, hit that like button, and make sure to subscribe because clarity is just one video away. Let's get right into it. Hey fam! I'm Dr. O, a trained psychotherapist turned trader and the proud founder of the Trading Psychology for Reparations channel. I created this space for one reason, to help Black investors realize that reparations don't have to come from Capitol Hill. They can come from the candlestick chart. We've spent generations waiting on a system that was never designed to see us thrive. And quite frankly, we're tired. Tired of the delays, tired of the excuses, tired of begging for what we've already earned 10 times over. But here's the truth they never taught us. The power has never been in their hands. It's been in ours all along. Inside our discipline, inside our strategy, inside our psychology. On this channel, I show you how to use the stock market not just to make trades, but to make a statement. That we are no longer waiting, we're reclaiming. And today, we're doing it one chart, one candle, and one decision at a time. If that resonates with you, stick around because this next lesson could be the very thing that shifts your entire trading journey. I use the exponential moving average as opposed to the simple moving average for 4 key reasons. Reason number 1, it reacts faster to price changes. In trading and in life, timing is everything. The EMA responds quicker to price shifts, which helps me make sharper, more informed decisions in real time. When the market moves off news, momentum, or institutional entry, I don't want a delayed signal. I want a clear response. The EMA gives me just that, early entries and quicker exits. Reason number 2, it helps me spot reversals sooner. Because of its sensitivity to recent price action, the EMA often signals a change in trend before the SMA even catches up. This is crucial when you're trying to protect profits or position for reversals. Think of it like spiritual discernment in the markets. It picks up the energy shift before the eye can see it. That extra head start can mean the difference between winning the trade or watching it flip on you. Reason number 3, it works better in fast-moving markets. Let's be honest, today's markets don't wait for anybody. If you're using tools that lag, you're going to miss opportunities. The EMA was built for speed. It's ideal for day trading, scalping, or any strategy that thrives on momentum. When paired with the right mindset and risk management, it becomes a powerful compass for navigating rapid-fire price action. And last, but certainly not least, it aligns with my psychology-driven strategy. As a psychotherapist turned trader, I don't just watch candles, I watch human behavior. And human behavior changes fast. The EMA captures those changes quicker and more accurately than the SMA, which is a critical tool for trading psychology. It helps me and my community stay in tune with the real-time move of the market and move accordingly, not based on outdated data, but current conviction. At first glance, both the simple moving average and the exponential moving average serve the same purpose. They smooth out price action over a set period of time to help you see the trend clearly. But how they calculate the average is what makes all the difference. The simple moving average takes the average closing price over a specific number of periods and gives each of those prices equal weight. For example, in a 10-day SMA, each of the day contributes exactly 10% to the final value. The exponential moving average does things differently. It gives more weight to the most recent prices, making it far more sensitive to the market's latest movements. That means while the SMA reflects where price has been, the EMA is more focused on where it's going. And that's why I choose to ride with the EMA. So let's talk about one of the most powerful indicators on your chart, the 200 exponential moving average, or as I like to call it, the elder of the market. Just like in a family, where the beliefs, values, and decisions often revolve around a matriarch or patriarch, the 200 EMA carries that same level of influence in the market. It doesn't flinch with every mood swing. It doesn't overreact to temporary noise. Instead, it holds the long-term structure together. When price is above the 200 EMA, it tells us the overall market is in a long-term uptrend. There's strength, there's direction, there's legacy. When price drops below the 200 EMA, that long-term trend has shifted, and now we're in a downtrend, often marked by fear, correction, or major transition. I remember growing up in a household where education wasn't optional, it was oxygen. My parents, and especially my grandparents, believed deeply that the way out of poverty was through the mind. Books were everywhere. Silence was sacred when someone was studying. In college, it wasn't a dream. It was the floor, not the ceiling. So it's no surprise that I went on to earn advanced degrees, to become a psychotherapist, and now an educator in the world of trading. My foundation was formed by the long-term mindset of my family values. The 200 EMA works the same way. It carries the long-term belief system of the market. It sets the tone. It sets the boundaries. It's not influenced by what happened this week. It reflects months, even years of sentiment. So when price is dancing above it, we're in bullish territory. When it drops below, the mood has shifted and it's time to respect the change. If you want to be a trader who builds wealth and wisdom, you can't ignore the 200 EMA. Just like you wouldn't ignore the voice of an elder who's seen it all. Watch it, learn from it, and most importantly, let it guide you along your long-term strategy with the same respect you'd give the pillar of your household. Short-term EMAs are like the youngest members of your family, quick to react, full of energy, and honest about how they're feeling in the moment. They don't wait for consensus or long-term validation. They respond now. And just like our children, they may not always have the full picture, but they often reveal important signals that can't be ignored. Take my daughter, for example. She might rush through an assignment, eager to move on to something more fun. As her parent, I can see her short-term decision and the outcome it produces. It's a moment that reveals something about her current mindset. When she's asked to redo it, this time slower and more thoughtfully, I'm given a second data point that shows growth and intention. Both versions matter. Both give me insight. And when I line them up side by side, I get a clear view of the story behind the outcome. That's exactly how the 3 and 8 EMAs work in my strategy. These fast-moving averages don't wait around. They respond instantly to new price action. They catch the early moves, the hesitation, the momentum shifts that hint at deeper story unfolding. When these EMAs cross or align with my trading thesis, it's like watching my daughter's real-time decision making. I can tell if the trade is rushing toward recklessly or gaining traction with purpose. So while longer-term EMAs might act like seasoned elders, wise and steady, the short-term EMAs are like the children in the house giving raw, unfiltered feedback. And when you learn how to read that feedback, you stop trading blindly. You start parenting your trades with love, discipline, and awareness. That's why I don't trade without my 3 and 8 EMA confirmations. They speak volumes, even in whispers. Now, let me introduce you to the heart of my trading strategy, the meat and potatoes, if you will, the 20 exponential moving average. This isn't just another line on a chart. This is the compass that guides my trading decisions every single day. It helps me balance my long-term vision with short-term signals, giving me a structured way to move through the chaos of a market with clarity and confidence. To help you understand it, let's make it personal. See, I'm an educated woman, and that mindset wasn't born yesterday. It was infused into me by generations of sacrifice. My parents and grandparents laid the foundation brick by brick, and their long-term bias towards education still influences me today. That's how I approach the market's long-term bias too, with reverence and recognition that it matters. But I also have kids. And if you're a parent, you know that their educational journey isn't something you just set and forget. Every day brings a new challenge, a new adjustment, a new decision to make. That's how I approach short-term price movement. It's fluid, it changes fast, and that's why the 20 EMA is so crucial, because it helps me navigate those day-to-day fluctuations without losing sight of a bigger picture. Now, here's the magic. I use the High Low 20 EMA channel. That means I'm not just watching the average, I'm watching the zone around it. When price breaks above the high of the 20 EMA, I take it as confirmation that momentum is building, and I position myself with calls because I believe the trend is going up. When price breaks below the low of the 20 EMA, I see that as a shift in energy. So I take puts because the market is likely heading down. It's not just reactive, it's intentional, calculated, calm. And let me tell you, this strategy didn't come from a textbook. It was born out of adversity. After being prosecuted and having my traditional career path disrupted, I made a decision. I wasn't going to sit around and wait for permission to thrive. I created my own lane. I took my training in psychology, mixed it with market structure, and built a reparations-based roadmap to profitability. Now, I teach it to you because your freedom might just be waiting on the other side of a 20 EMA breakout. Let's keep rising together. To enhance these strategies and ensure I'm not just trading with emotion, but with evidence, I layer in 3 key indicators that help me confirm, clarify, and execute with precision: the RSI, the ADX, and the MACD. First up, the Relative Strength Index, also known as the RSI. This is my emotional truth detector. It tells me whether a stock is overbought or oversold and helps me identify when the market is running too hot or cooling down. RSI helps me check in with the market mood before I make a move, because in trading, just like in relationships, timing is everything. Next, the Average Directional Index, also known as the ADX. This one's all about strength. It doesn't care where price is going. It just tells you how powerful the move is. Is the trend real or just a flicker? The ADX keeps me grounded. It tells me when to ride momentum and when to sit on my hands, avoiding trades that look good but lack conviction. And finally, the moving average convergence divergence, also known as the MACD. Think of the MACD as your trend whisperer. It spots changes in direction before your eyes catch it. When the MACD line crosses the signal line, it's often a hint that momentum is shifting, either picking up steam or about to cool off. I use it to fine-tune my entries and exits and avoid emotional trades, because guesswork has no place in legacy building. When used together, RSI for emotion, ADX for strength, and MACD for direction. These tools form a complete system, a strategy rooted not in hype, but in harmony. One that has helped me build consistent income, even after life threw curveballs I never saw coming.
Okay, I am going to show you how to set up my signature High Low 20 EMA. So I, as you know, use the SPY. So you're going to go to www.tradingview.com. And I'm not going to leave the site because I'm already here, but we're just going to type in the ticker symbol SPY. Okay, so this is the screen that will come up. And I think the easiest way to start would be with the EMAs. So I go to these candles here. It's a series of 4 candles with looks like an EMA above it. And I have all mine favorited, but we'll start from the beginning. And so we're going to do the moving average. I'm just typing in moving average and it comes up. Okay. Now we're going to use 5 of them. So I've done 1, 2, 3, 4, 5. And they all come up in blue, like this bluish. Well, there are different, I guess, ranges of the blues, but they are all here as the 9 EMA. So we're going to change those so we can tell the difference and actually set them up correctly. So the 9 EMA, we're going to change the first one to the 200. I like this. Remember, the 200 is letting you know the bigger picture of the trend, and because of that, I like mine in red. Okay, so you see how that blue line moved and now it is red, and I make it a little bit thicker. In fact, I use the 4th thickness one because it's just really important, so I like it to stand out the most. And then we're going to save it here. Okay, so we've got our 200 EMA here in the dark red. Now let's go to the second one. We're going to click on not the 3 dots, the little settings tab. This one, for the input, we're going to put 20, and it's naturally on close. So we're going to put it on the high, and high to me means the upper side of the EMAs. So we're going to make this green. I like to make these also a little bit thicker. So where are, instead of keeping it on 1 thickness, let's put it on 2. Okay. All right. Now we've got our second AMA. This is this green line right here. Sorry for the stuttering. I just had some really good fried chicken. I don't know if that's why. Anyway, we're going to our third EMA. This one is also going to be 20, but this is going to be the low. Okay, so remember earlier we did the 200 EMA in red. I also like this one in red, but I can tell the difference because I have this one with the 2 thickness. So I know, and again, this is just what makes it easy for me. I know the differences because 1, the 20 high and low EMAs follow this exact same pattern, but 2, I know the 200 EMA is the thicker red line and the 20 EMA low is the thinner red line. All right, the next one is going to be 3. And I'm not really particular about the color of this. I think I have it as yellow, it doesn't really matter to me. I just like to see when it crosses the 8. Oops, I hit that, sorry. Okay, so we're gonna make this 8, and I believe I have this as orange. Okay, so those are how we're going to set up the EMAs. Now we're going to put up the VWAP. Remember the differences between the VWAP and the EMA. Let me type it first. Volume, and it comes up for me, but it's the volume weighted average price. Remember the difference is the volume weighted average price is what it looks like for the time frame. So once we set this up, I'll break it down for you. It comes up in blue. I don't know why they like blue so much, but I like white. And I also like to get rid of the other bands. So I would unclick all of these and I would save it. All right. So as you can see right here, the white line is the upper and lower end of the price for that time period. So I use the 4-hour the 4-hour time period. So you can see, take this candle right here, and you can see that above this, that's the first half, and then below it is the second half for that time period. All right, let's just save this just because I don't want to lose any of my work. And now the next one is we're going to go to, let's do the relative strength index. These are my confirmation pieces. So, yep, that showed up. Now, this is how I like to set mine up. So, for those of you from the United States, and different roads look different. You know, I've been to different places. So, but this to me looks like a road the way I set it up, and I'll break it down to you to make it clearer in a minute. The first thing I like to do is uncheck the RSI based MA, which is the mean average, because I just don't know how to use it and don't really think it is relevant. All right, for the upper band, I like to make that white. And I also like to have a solid line. Okay, this is one border of the street, sorry. The solid line. All right, and then I'm going to go to the lower band and make that white also, and this is the second border of the street, and I like a thick line. And then I don't know if you just look in the middle line is the 50. I want to make that white as well, and I like to make that a little bit thicker, maybe a lot thicker. And to me, that looks like a street, but it's really helpful because it helps me to see. Okay, y'all, the secret's out of the bag. I'm holding my daughter while she is asleep and recording this video. So she's wanting to make her grand entrance. Say hi. Maybe I can hold her like this while I can finish. So then we're going to add the MACD, and the MACD will be, let's see if I can do this with one hand. MACD, yep, the moving average, convergence, divergence, and we just, no, I don't use the strategies. You can use it. Well, I don't even know how to use it, so I just use the regular MACD. And I like for my signal line to be green, and I like for my MACD line to be green, and I like for my signal line to be white. And last but certainly not least is the ADX. So I'm just going to type in ADX, average directional index, and it comes up as red. I like to make it a little bit thicker. Don't really have a reason for doing that other than cosmetically I like it that way. All right, so we're going to go here and change the style of thickness. All right, so we've got the ADX here, we've got the MACD here, we've got the relative strength index. We have 5 exponential moving averages for the 8 and the 3, the 20 low, the 20 high, and the 200 EMA. And oh, I forgot the parabolic SAR. So we're going to go back up here and just type in, I mean, I have it starred because we use it all the time, but I'm going to do PARA. Yep. And again, I'm not doing the strategy. I just do the regular one. Okay. All right. And I can't tell. I don't remember if it's because I saved mine as blue or if it comes up as blue. But so the way that this works together, okay, I like to start with the parabolic SAR. So let's say we're starting with this parabolic SAR right here. I can see, so the parabolic SAR, the reason why I like it, remember that the parabolic SAR is the stop and reverse, so parabolically. So as soon as it triggers, it gives me a warning and lets me know, okay, you need to start looking in this direction. I'll probably do a lot of my charting at this point, but right here, and it's a little choppy right here, but for the sake, but we're just going to roll with it because the parabolic SAR has already told us that the trend is going to be up. Okay, so the 3 and the 8 is going to cross. It crosses somewhere right here. Again, it's choppy, but so you don't know if it's going to be up or down. But the parabolic SAR is giving you confirmation that it's going up. Okay, so if you wanted to wait for just an extra form of support, then you could check here and you can see the MACD. So when I like for all 3 of them to be lined up. So the parabolic SAR says it's going up, the 3/8 crossover says it's going up, and the MACD says it's going up. This is a good time to enter around these 2 candles. And then what I would do is I actually cannot get to the side right now because I'm recording this and I don't want you to miss it. But what I would do is oh, here's the tool right here. It's hard for me to work with one hand and I'm using my left hand at that. But for those of you who don't know, there's typically 3 lines over here that has the tool for whether you're going to go short or long. So here we would be going long, and what I would do is just put an entry point around here. I would move my stop loss to the end of where the last swing low is, and I would try to go for a 1-to-1 or see, this would be a 1-to-1, so you can see what this looks like. It says 0.9. What? Oh gosh, my hand moved. 1.1. Maybe I'll switch hands. Okay, this is a 1.103. So 1-to-1. And as you can see, that clearly met that. I usually do, depending upon what it looks like, a 1-to-1, a 1 to 1.5. This is a 1 to 1.5. It still works there, and then a 1-to-2. Anything after that, I like to kind of, I'm a little bit guarded by. But as you can see, this strategy works. So the goal is to make sure you have the 3 indexes or the 3 indicators line up. That is the parabolic SAR confirming the direction, the MACD confirming the direction, and the 3/8 crossover confirming the direction. And the only other thing I want to make sure that is clear is that you can see here, this is still all within the relative strength index, so there's no major extremes, so there's no reason to really be guarded here. And another form of confirmation, this is a really good trade. I probably did take this trade since the thing was already here, but I just want to make sure that you understand, remember that the ADX it does not show the direction, but it does confirm the trend. So as you can see, the ADX is here at 29.5, so it's going down and the trend is going up. So this is just a reminder that the ADX, just because you see it going down doesn't mean the trend is going down, but it means that there is a trend to go up or down. It's up to you to determine the direction of the trend, and we do that by using the MACD, the parabolic SAR, and the exponential moving averages. Okay, that's all I have for you. If you have any questions, please leave me a comment below.
If you're ready to learn how to use these tools to make 6 figures in the stock market, then tap into my exclusive playlist, How to Make 6 Figures in the Stock Market, where I break it all down step by step. You didn't stumble across this video by accident. This is alignment. You've been searching for clarity, for strategy, for something that finally makes sense, and you found it here. Not just tools and terms, but a message that speaks to both your potential in your power. That means you're already ahead of the game, because the first step toward transformation is awareness. And family, you're awake now. The stock market is no longer reserved for the privileged few in glass towers. It's not just for hedge funds or Ivy League graduates. It's for you. For your grandmother who never got to retire. For your kids who deserve generational wealth. For the legacy that refuses to be silenced by systemic delay. When you learn to read charts with emotional clarity, strategic alignment, and historical understanding, you stop gambling and start reclaiming. And let's be real, this journey isn't easy. There are losses, there's doubt, there's noise. But the difference between those who succeed and those who give up, community, consistency, courage. That's what I offer inside the Trading Psychology for Reparations program. It's not just a course. It's not just education. It's a movement rooted in psychology, driven by purpose, and designed to unlock the financial restoration we've waited far too long to receive. So if you're ready to stop wandering and start winning, I want to personally invite you to join our community today. You'll receive daily key levels, support, and strategies to help you trade with purpose, confidence, and discipline. Drop a comment to share your journey. Hit that like button to amplify this message, and subscribe so we can keep growing this family of fearless Black investors who are done waiting on reparations and ready to claim them one trade at a time. The charts are waiting. The levels are in. And your time is now. You've got this. Peace and blessings, Dr. O.